Morning, everybody. Happy Fed Day. Happy Hump Day. Give me 1 minute here. Running a little behind today, if you can't tell. Turn up my volume so you can hear me. There you go. Give me 1 second here. I'm almost there. All right. Good morning, Maxime, hidden in Daniel's room. Welcome to the stream. WG Shocker, welcome to the stream, everybody. Good morning, Jacob, and happy Fed Day. Looking forward to see market reaction to Powell's purple tie. Wish you all a green trading day. Please pray with me to have Fed uncut the rate. It won't matter, Daniel. Whatever he does or says today doesn't matter. It's honestly, it's noise is what it is. It's just noise. Save your short positions and to make good long entry points. Yeah, I mean, for now, buying the dip is obviously the king strategy. It's working very well. I do think we're getting near a very very big inflection point, but until support breaks, that's not the case. So there's no reason to worry about the market until that happens. If you were kind enough to comment on my or see my Instagram yesterday, if you're not on Instagram, you should follow me over there. I put out a update every morning with a key levels alert for one of the markets, as well as usually some kind of trading tip. I talked about the market that I thought would bring down the sector that would bring down the market, and the answer, if you couldn't tell in the comments, is the banking industry. The banking industry has major cracks in the foundation, and tech relies heavily on the banking industry. They need to borrow money for innovation. They need to borrow money at rates that matter. They need to have availability to money. They need to have availability to debt. And if the banking industry starts to go down, and I think it will very strongly, the rest of the market will come crashing down with it. And then the driver of that crash, the hammer that is pushing the market down, will be tech. It'll be AI. It'll be the Mag 7. Those stocks reverting back towards some more appropriate levels, and quite frankly, levels that haven't been back tested, will be the hammer that pushes the market down. But this is a huge but, because baby got back. Until that happens, this market is extraordinarily bullish, and you are at the end of a euphoric blow-off style move, and those can last for a while. So be very careful in this market. It is very strong to the upside right now. Today will be a wild day. You have throughout the day, so regular trading hours will be kind of probably boring. Hopefully not, but usually on Fed day they can be choppy, especially if you don't get any kind of real strong move in the pre-market. I mean, we're up 0.25%, but Fed day can be choppy in the first half of the day, then wild the second half of the day. But then on top of that, this afternoon we have 3 tech earnings that are megas that will very likely push this market to where I think it's going, which is 7,025, 7,035 on the ES. That 7,000 level, it's about 100 points up from where we are now. So what you could see, there's a ton of scenarios for today, but we'll go through just a few of the more common ones. You can see the Fed do this, drive it up into that 7,000 area. So that'd be about 100 points up from where we are right now. And then with earnings, you could see this, right? That is definitely a possibility. You could see the Fed do this. You could see earnings do this. You could see the Fed do this and then earnings do this. You could see the Fed do this and then earnings do this. There's a lot of things that can happen. Ultimately, we'll try to stay back and trade the first half of the day. I never trade the nonsense of the Fed. It's too wild. The moves are too fast and too unpredictable in the sense that they could the market already knows what it's doing today. You guys probably don't believe that, but the market already knows what it's going to do today, and it doesn't matter what the Fed says. But what they do is they may have a plan to take the market higher on the Fed news, and you're positioned perfectly because you have a long at wherever the market is, and then he comes out and speaks, and they do this for the first 10 minutes, stop you out, and then they go long. And this stop out is so fast and furious that you get crushed, and it's just a really difficult thing to trade most of the time. So the best course of action, in my opinion, is either give it 15, 20 minutes, wait till he starts to talk because they release it at 2 p.m. and then he starts to talk at 2:30. If you wait a few minutes after that, you can kind of start to see what the trend is going to be. If you want to gamble on that, and I call it a gamble because I think that the Fed is it's a wacky day, if you will, or just sit it out completely. But to each his own. So if you guys want to play it, please do. If you're new here, we are going to live trade the Invest with Jacob Pivot Point Pro indicator. You can see it on the chart. You see the sells and the buys. Some important concepts to understand. If I hit the eyeball, you can see them disappear and reappear. We don't trade any of this. So this is blue. The market closes. You get the bluest post-market around midnight. It switches over to pre-market, and this is all the pre-market trading here. And so this doesn't get traded. However, we do need it on for the indicator to work. We only trade the first part of the day, so we trade until my chart's still on Pacific Standard Time because I was in Washington not that long ago. I've moved to Kentucky since. But we only trade until 10 a.m. on Pacific Standard or 1 p.m. on Eastern Time. You can figure out where you're at if you're in the middle of that or you're in Europe or Asia or somewhere else. But we only trade basically the first 3.5 hours of the day. Because that's where the volume comes in and that's where most of the moves happen. Now, today is a different kind of day, and a lot of times today the volume waits until the Fed, so you get a choppy day, which isn't that fun to trade. So we'll see how it goes in the morning. It could be a short live stream. It could be a fairly active one. We've seen both on Fed Day. But the reason we trade only the first half of the day is on most normal days, that's when all of the volume and the moves happen, and then the second part of the day, yes, there can be moves. Yes, there can be rallies and sell-offs and things like that, but they're harder to catch and they're harder to see, and a lot of times the market goes sideways. So we stay out of that mess. We trade with the concept of we enter a trade and we're looking for a 20% win on the first half of that trade. So we close half at profit 20%, and then we let the rest ride into the next key levels and gradually close pieces of it into our target area. As the money moves in our direction, well, we set a stop. So let's talk about that first. So if we have a 690 call right here, if we have a 690 call, and the price is at 690, our stop is going to be 50 cents lower than 690. So that's going to be 689.50. If we have a put at 690 and the price is at 690, then our stop is going to be 690.50. So it's a 50-cent stop in either direction. Now, as price moves, so we have so right now, we'll just do a live one. So right now, it's 688.81 roughly. That's a rough guess. 688.81, and let's say we have a call. So that means our stop's going to be below us. Our stop is going to be 688.31. That's a 50-cent subtraction off of where we're at. So 688.31 is your stop. As price moves up, if we get a 10% profit, we're not taking profit there, but once we hit 10% profit on our option, we move our stop up 25 cents. So from 688.31, you'd move it up 25 cents. That'd be 688.56. If price gets up to a 15% profit, we move our stop to break even. So if we get to 15%, we haven't taken any money off the table, but our stop is now break even, so we have a risk-free trade. Then once we hit the 20%, we take profit, and then we try to let it run, and let's say we take profit here at 689.48 because that's the pre-market high. The next area we would look to take profit is going to be our next call resistance box here at 690.01, and that's about 50 cents higher, which would get us another 20 or 30% or so on our trade. So we have great risk parameters. We let our runners run, and that's how we come up with the wins and the winning percentages that we do, because we don't allow our losers to lose. I mean, obviously we do, but we stop them, and we allow our runners to run, our winners to run. So that's how we architect that. That's all explained in once you get the indicator. It is at investwithjacob.com. And then once you get it, you'll be taken to a page where there's a bunch of videos that explain exactly how we use it, exactly what we do to achieve the results we do, and how you need to use it. It works on any stock, on any index, on any currency. You can use it on anything. I recommend you use it on the higher liquid stocks like the Mag 7, like the indexes, things like that, gold, things that move and things that have liquidity, because you can get stuck in stocks that aren't traded very much and aren't optioned very much. You can get stuck with liquid problems having liquidity in those types of environments. I've had people email me a stock that for months has literally done this, and they tell me the indicator doesn't work. Well, they're getting false buys and sells because honestly the stock doesn't do anything, and then you look at the history of the stock and it doesn't do anything. The stock, I don't know why anyone is trading the stock, to be quite honest with you. You don't want to trade things that look like this, whether you're using an indicator or not. This is just nothing to trade. There's nothing, unless you're doing iron condors or something like that. There's nothing here to trade. So you need stuff that has some volatility to it. You need stuff that's going to move to give you payments. You don't want to be trading nonsense because you're not going to make money and you're going to be frustrated, and it's not going to work out. You need movement and, stocks that have the ability to be bought and sold quickly. We are at the open here. We are currently in a buy. So we would be looking for a potential sell. However, we may get a buy stop here as they are arching over into the open. So 6 seconds here. We'll see what we're doing and get set up here. Yeah, it looks like we're going to maybe get a long stop. So if that LS prints on the screen right there, that's a long stop. So you hit a buy here in the pre-market. Obviously, we don't take that buy because it's pre-market. This is telling you that this buy is stopping out. And that means that the next signal is going to be a buy signal. Breadth, again, is bad. It's negative 436 to open the day today. Vold is negative 25 million. So breadth has been bad the last few days, and that is for me, kind of a tell that today may be a down day, and the Fed and earnings may push us down in a wave 4, and then wave 5 comes back up to 7,025. We'll see how that plays out overall, but that is something to keep an eye on. If the bears are going to take it down, they really need to break through. The start's going to be 687, 68. That's going to be a great area to look for a buy signal, honestly. But then down here, yesterday's close and really the lows of the day, the overnight lows. So this pre-market low only looks at the yellow portion because that's quote-unquote the pre-market. But the true pre-market low is back here at 686.65. So getting through that would be a good start. That's just a start for the bears. They got a long way to go. Once again, we have mismatched markets. And what I mean by that is the NASDAQ has a green candle and the ES has a red candle. And again, breadth is the problem. But if you look at the Mag 7, I haven't even looked. I know it's on my screen, but I haven't looked. So if we scroll over here and look at the Mag 7, I bet you it's pretty strong. NVIDIA hitting that 205, 209 area. So they have hit their target and exceeded it. 4%. Meta up 3. Microsoft up 0.3, a quarter percent on Microsoft. Netflix is still down. We've talked a lot about Netflix being a dog right now. Amazon's up almost 1%. Tesla's up 0.5%. Apple's flat and Google's up. So the Mag 7 is just bench pressing the market yet again. Again, you have breadth that isn't great, although it's improving right now. And you have a market that won't allow it to come down. RTY red. And that's where, when you see that breadth, this is what you're looking at, is the small caps. And they are failing right now. And not failing in a big way, but they are, over the last 3 days, they have shown negative results, whereas ES and NASDAQ have been gapping into highs. George, welcome to the stream. I'm doing great. How are you? What is the breadth? It's breadth. Breadth. It is the overall health of the market. And when breadth is bad, the market is bad. So what it tells you is the ADD kind of gives you the overall breadth of the market. And what that is right now it's negative 326 for today. There's a running total, but today's total is negative. And that tells you that 323 stocks are. Let me see how I'll explain this a good way. So the ADD takes every stock and it looks at yesterday's close. And it takes every stock that's trading above yesterday close, and that gets a value of 1, and every stock that's trading below yesterday's close, and that gets a value of 1. And then it simply subtracts stocks trading above their close. Stocks trading below their close from stocks trading above their close. So you subtract that number, and if it's a negative number, that means more stocks are trading below their close. In this case, 338 more stocks are trading below yesterday's close than above. And so that means that more of the market is red than green. Now, it's not heavy. Heavy is about 1,500 plus. It's actually fairly light. You would call it just kind of slightly down. But yesterday, it was negative 800, 900. The day before, it went from positive 1,300 to 0, which is a big swing. And that tells you the overall health of the market. So what we have is what we call a concentrated market. And it's all concentrated basically in the Mag 7 and a few others. There's, Avgo and a couple others that are really pushing this market. But historically, you've never seen anything like this. That was very Donald Trump of me. We've never seen anything like this. This is the greatest stock market you've never seen. Historically, we've never seen anything like this in the fact that literally 10 stocks have produced almost 40% of the gains in the market over the last 5 years since COVID. 10 stocks are producing 40% of the gains. That is an incredibly concentrated market. That means those 10 stocks fully control the market. And what helps those stocks? The banking sector, which is why I think the banking sector will be the crash of the market. But my point being that when those stocks fail, think of .com. All the .com stocks controlled the market. And when those stocks failed and went out of business, now the Mag 7's not going out of business. Let's be clear about that. For the most part, for all parts, those are great companies that are not going to be going out of business. However, they do have corrections. They do have reversions. They do have pullbacks. And when that happens, they are powerful enough that if they start to pull back and breadth is bad, which we're seeing it is, well, we're not seeing it is in a big scale. It's turning down a little, but for the last few days, it's been red. When you see that, if the Mag 7 starts to weaken even a tiny bit, the market really sells off quickly. So that's kind of a long version of a answer to a short question. Hopefully that made sense. Will, welcome to the stream. Good to see you, buddy. All right, guys, we're up into this call resistance. They did not close this with a long stop, so this buy is still in effect. They tried to stop it out, but the close was not good for the bears anyway. So you are seeing a continuation of this buy signal. Big picture, there is a monster call. If we go to the SPX, you can't see the size of it. It'll just tell you it's there. But on the SPX, 7,000 is a monster. It's one of the biggest call walls I've ever seen. And we saw a very similar one. It was a little smaller, actually, on gold at 400 GLD. And it rejected it like 8%, I think. Right, so it's 69. That's the one day max. May not be on there yet. No, it's up there. It's your call resistance up here. So the 1-day max, if you don't know, tends to hold the market move to the upside, and the 1-day minimum tends to hold it to the downside. Now, on days like today, where you have Fed plus earnings, you can get that hurricane effect, and we talk about that all the time. The 1-day max and the 1-day minimum are kind of your shorelines. People build houses based on the tides and the shorelines because they know where the ocean's going to come every single day. However, when a hurricane hits, that shoreline is no longer effective. The surge pushes the tide all the way up into houses, and it blows past it. Today has the capabilities of that because you have a lot of catalyst. So this 1-day max at 69.50 on the SPX is a place to watch, especially if I think you could definitely see something where they spike it up into here and fail. But I would definitely look for rejection at 7,000. When I say significant, I mean 2-3% minimum. That doesn't mean we're talking about that being the all-time high forever and then going down. I'm just saying this level is hugely strong for rejection. ADAD, welcome to the stream. No roosters in Kentucky. That's correct, George. AD says, what does a call wall mean? How does the market react to it? Is it a magnet, or does the market maker want to avoid it? Good question. Really good question. So the market maker wants to avoid it. So what you see here is you see your call resistance and gamma wall here on ES at 689. This should hold a lot, and you have already seen them reject it here, and they're trying to reject it again. What this is this is a stacked set of calls. In other words, maybe down at 688 you have, and just for simple numbers, 50 calls. And up here at 689 you have, say, 1,000 calls. The numbers are actually much, much bigger than that. I'm just trying to make this simple. So this is where the most calls for the 0 DTE, so for options expiring today, this is where the most calls are sitting. What that means is, and why it's a gamma wall, is if price gets above this call wall, okay, the people who sell those calls, so if you buy a call, somebody has to sell that call to you. Most of the time, that's the market makers. That's the big institutions. They're selling that to you. And so what you'll see is they want to defend this zone very, very, very strongly, because if they fail at this zone and it pushes through, well, now they have to hedge. Okay, think of a bookie. A bookie wants basically even money on both sides of the game, and this is not even money. This is stacked on one side of the game. So if it starts to go up here, all of these calls get paid, right? That means the bookies have to lay off on this side of the tape, which means they have to buy calls to hedge their bets, which means you're going to see a gamma squeeze. That's a lot of work for them and a lot of cost for them. They don't really want to. They will. So what happens is you either reject this zone because the market makers hate it and they do not want to give it up, or you get a gamma squeeze, and those gamma squeezes are what we've seen the last few days, where the market gaps up and goes, and just continues to grind higher because the market makers are underwater and they have to cover their calls. So call walls are market makers want to, they'll let price come to there because it's a good trapping place. People think that it's going to break through and go, and then they reject it. But they really don't want price to sustain above that, because then they have to hedge and do extra work and spend a lot of extra money and energy and time to keep their position safe. And it essentially causes a very, very strong squeeze. And that's how squeezes happen. So you have resistance. Resistance is almost always these zones. Okay, so this is your resistance for the day. You can see the pre-market higher got above it and immediately came back below it. So this is going to be your actual resistance, and then the pre-market high is going to be kind of the tell of, are they going to sustain above this call resistance wall? And then once they break through these zones, this is when squeeze happens, because the market makers have to cover. So now they're buying. And what that means is they are adding fuel. So any shorts that were sitting here trying to short the market here, which is not a terrible play, one, they have to close because they're stopped out. That's buying the market. Two, they want to get in on the run, so they buy the market again. So that's a double buy of the market. The market makers have to buy the market to cover their sells. That's a buy of the market. And then the FOMO and all of these calls are also buying the market. So the call walls and the put walls are very, very huge levels of resistance and support, and they're great to trade off of in most cases because of that. Now, do they fail? Absolutely. That's how we get squeezes. That's how we get markets that run. So what happens is you'll come up here the first time, maybe, if I can get my drawing thing to work. What happens is, there it is. You'll come up here the first time and you'll reject it because it's strong. They'll come up here again, they'll reject it, and then they'll come up the third time and they'll start to do this. And then this is when you get your squeeze. So you have a wall, which is the squeeze area, and then you have resistance, which are other high volume areas. So this might be, let's say, 1,000 contracts, and this might be like 800. So it's not as big as this one. This is the main one. Hopefully that made sense. Because sometimes it feels like I draw all these lines on here and it looks like a beautiful mind, an old movie with Russell Crowe or whoever was in it, where he just draws all the stuff on the walls and nobody knows if it's real or fake. It's kind of an odd movie. Jacob, does market maker place shares at key resistance support levels to move price, and or do they actually buy sell shares to move price in desired direction? Yes. Yeah, they do. I've been paper day trading. A couple weeks ago, I was crushing and thought I was a genius. Past week, I'm getting trashed. What happened? So, what happened is just what you can call mean reversion or averaging. Um, Essentially, here's something that traders don't tell you, right? Everybody wants to tell you their wins. That's the easy part. Every single trader out there, Tom Lee, all of them, every single one of them. You're seeing them get through here, by the way, and you're starting to see these jumps that can turn into a real quick squeeze, by the way. Every single trader loses, and every single trader has losing streaks. Trading is a game of edges. So if you understand games of edges, they're like trading, poker. Those are two main ones. There's probably others. Those are the two I know. But essentially, there are days that you get your money in poker with aces against kings, and the guy hits a king on you. What's the probability? The probability is that you're going to win that hand 66% of the time, or 70% of the time, I think it is. So 7 out of 10 times, aces should win that hand. However, as a poker player myself, I have had pocket aces cracked 6, 8 times in a row. That's against the probability. Probability isn't about short-term numbers. It's about the law of large numbers. And so over time, those aces will win 70% of the time, roughly. The aces may win 25 times in a row, then lose 10 times in a row. They may win 1, lose 1, win 1, lose 1, win 6, lose 2. It's not about what happens on any given trade or any given week or even any given month for that matter. It's literally about what happens over a year, several years, and so on. If you're losing month after month, you have a problem. If you're losing for a week, 2 weeks, a month, not that big of a problem. But you need to make sure that your edge is right. You need to make sure that your strategy is right, and you need to make sure that what your risk reward and all of that stuff is dialed in. If as long as that is okay, you will be fine. But you're going to have to go through these ups and downs, just like the stock chart. The stock chart doesn't go like this, and it doesn't go like this. The stock chart goes like this. Is Apple making money when it does this? The answer is yes. You can see all higher highs. Does Apple lose money at times? Yep. So you just have to understand that any trading at all is a game of probabilities. Is it more probable for this stock to go in the direction I think it's going? If the answer is yes, and it's a significant probability, in the stock market about 60% is significant, then you have a good trade on your hands. Whether you win or you lose does not matter. It is a good trade. If you take that same trade 1,000 times, you will make money over time. This is why sizing is important. This is why you don't go in with your whole stack. This is why discipline is important. This is why you don't chase trades. You must trade good, solid trades. I got to get set up for a potential short here, guys. So I'm behind here because I've been bullcrapping instead of watching. We're not there yet, but we're close. Very elevated prices today because of the Fed. That's stupid. That's normal, but stupid. Okay, we got six. We're gonna go 688 is gonna be our strike if we get a sell signal here. We don't have one yet, and we'll see what we get for the cost. So 688 will be the strike, and we'll have to set up everything else after that. Okay, we're ready now. So as long as you're taking solid trades with solid reasoning and the probability of those trades is right, you're going to go through losing streaks. You just are. In fact, we went through one in August, and September was basically flat. It's 2 months of kind of shitty trading, to be quite honest with you, because there are times that the market is irrational and problematic is what I will call it, because it's not following the playbook it's followed for however many years the market's been open, And when it deviates from that, which it does from time to time for short periods of time due to euphoria, due to what do they call that? Capitulation, due to sell-offs or whatever's going on in the market at the time. Sometimes it's a very long period of consolidation. When the market does that, it can throw off your results for a little bit for a short period of time because it's doing the less probable thing. And then it will correct itself and you'll have an incredible trading run again. So all trading is a game of probabilities and applying the edge relentlessly and understanding that as long as you are disciplined and use the right sizing, you will make money over time. This is not a get-rich-quick scheme or something to put all your money into blindly. It is something to understand as an edge, gives you an edge, and used properly will produce money for you. If everybody could make money on every trade, it wouldn't be a trade anymore. It'd just be stupid, and nobody would do it because it's solved. It's figured out. Nobody'd be on the other side of that trade. So this is a good rejection of the pre-market high area so far. They're trying to close back down below the three major levels, which would lead to a failed breakout, which would lead back to at least this low here at 688.29, and more commonly this low here at 687, especially if they can't hold this one at 688.29. Now, they do have to close. They haven't closed a candle below these three moving averages, but if they do, that's your likely destination. Secondary, if you just want some price action training, there it goes. Wicks like this into support. So today's open was right here. You have a long wick that's green. You have a long wick that rebounded. You have a long wick again, all into the open that couldn't get below the open. The open is a critical price zone. They couldn't get back below the open and close the candle down there. That's bullish. And it immediately spiked up there before I could get the words out. Market makers playing games yesterday. 11:30 dip stopped everything out. Yeah, they've been playing a lot of games lately. And it's not even games. I mean, some of it is. There's no question about that. But it's that the Mag 7 is controlling the market, and so the market is really having a hard time dealing with that. In the sense of the Mag 7's been controlling the market for quite a while, but I mean in the sense of the last few days, The market breadth has been terrible. The RTY has been trying to go down. The RSP has been going down, but the ES, the SPX, the NASDAQ, and the SPY are all battling that. And so you're getting these competing narratives where all the rest of the stocks are hurting, but the Mag 7 say, well, we're stronger than you, so we're just going to go ahead and pull you on up. So you're not getting the follow through on things that you would normally get. Sorry if my connection. I only have a few more weeks at this place. We're buying a house, and then I'll have regular internet again. It's I don't know if it's because I'm on mobile Starlink or whatever that it doesn't keep the stream well. On all of my afternoon calls, they're almost an hour long, and I never have an issue. So I don't know what goes on these morning calls, but um, in a few weeks that'll all go away. So I do apologize for that. Have you ever read Secrets of a Market Maker? No, that sounds like an interesting book, though. I'll have to check that out. Is it good? Have you read it? So typically, uh, just to recap that, wicks into support are strength in the opposite direction. So in this case, bullish. The wicks came down into support, couldn't stay down there, closed well away from it. In fact, closed higher each time. That's a bullish signal, which is why we didn't get a sell. I mentioned that today in the morning it might be choppy. So far, it has been a little bit choppy. Bulls are testing the pre-market high here. We'll see if they reject it. They're not quite at it. They spiked a high earlier, and this was a pretty good selling point. So we'll see if they sell again off of this. You can see they had a pretty straight down sell off of that spike up. Um, and then they got a pretty solid run up here on this buy and this sell. So there was movement in the pre-market. You would expect some of that movement to be retraced in the regular trading hours, and maybe it will after Powell starts to speak or after the Fed announcement or whatever. Maybe they'll come down and test these levels, but we'll see. We are in a zone where we can get a rejection off the pre-market high, which is exactly where you want to get a rejection. You either want it off a call resistance zone or the pre-market high or the pre-market low. Those types of levels are really good to trade off of. Breadth has continued to improve. It's up to negative 220 now. It was at negative 450 to start the day. Into the critical pre-market high area. Getting through that starts to identify as a trend type of day. So if you're new here and you don't know, getting through the pre-market high, so they got to get through it. Then they pull back and they test. So pull back and test either the 8 or the 21 in VWAP, either one. Hold and then make a new high. So it's not a trend yet. It's a trend when they take out the high. So they make a high, back test, take out the high. That is a very strong signal of a trend today because you have created a higher low and a higher high. You have held support on the trending metrics, and you are above the pre-market high, which contained the move overnight. So when you break out of the overnight range and you do it on trending metrics, it tends to be a trend day. Is it always a trend day? Everybody should know the answer is no. Nothing is always in the market. There is no always in the market. That's not a real thing. Okay, now they have the capability of turning this into a trend day. Any pullback that tests either the 8 or this level here, holds and comes back up, will be considered a trend, and takes out the high that they make here, would be considered a trend day. We have pre-market cup and handle, probably shoot up on the Fed decision. Yeah, I wouldn't be shocked at all. You have uh, you have 7,000 right above, and I wouldn't be shocked on a few things. They could go to 7,000 right now, and then on the Fed reject it. They could go to 7,000 on the Fed and reject it. I don't think they're getting through 7,000 SPX today. Though they might be able to get through 7,000 ES, because 7,000 SPX is going to be roughly 7,025 to 35 on ES. What do we apart here? 32. So 7,032 would be 7,000 on the SPX, because futures are of course higher. Um, so I don't think we're getting through 7,000 SPX. If they run through 7,000 SPX and don't look back, we are definitely in a blow off top. That is 100% a fact. I don't know where that will end. They could take it to 10,000, but that is a um, insane amount of bull demand that would have to show up at an insane level um, to break through that level. So I think 7,000. If you are trading today, and at any point we hit 7,000 SPX, I would short that area confidently, not stupidly, confidently. I would still keep my sizing. I would still keep my normal trade, and I would give it a little bit of time. If they get about 7,010, 15, something like that, that's fine. They can still reject that. But I would be very, very surprised if they got through 7,000 SPX today, whenever they get to it, whether it's today, tomorrow, or Friday. The first time they reach 7,000, I will be shocked if they get through it. Now, because we haven't fully identified as a trend yet, we will take a short should it come, because there's two reasons for that. One, when you get the short, they're likely to retrace down here to 688.99, which is not a big drop at all, but should get you coverage for your first profit take. And if they fail down here and start to go, it turns into a failed breakout, and then you get something like 687 or even 687.08. So you can get a really nice run down here and make a really decent trade. So we will take the first short, but if that short fails, in other words, they come down real quick to here and then come back up, excuse me, then we will be done shorting the market for today. I've already started to put in some shorts the past 2 weeks. I know you don't do it until you get the indicator signal, but I don't want to miss a 10 to 15% drop. Well, one, an 8% drop is probably the most likely thing. Two, if you get one. Two, the indicator is pretty good at getting in early. And three, not wanting to miss a 10 to 15% drop, but you've put in 10 trades trying to get that 10 to 15% drop, starts to even itself out. So if you put in 5 trades that lose, and on the 6th trade you're right, then you're essentially in the same place as you were. So think of it this way. If the market starts to come down and the indicator says to get short here on this bounce, but you shorted here and here and here and here on the way up, and they failed or stopped out, well, by the time you get back to where you started, the indicator's in anyway. And we got in with a lot safer of a position because it started to show weakness and started to show us why we should be short. And that doesn't mean we're right. Right now we're in a short that's not working out. That happens. But trying to guess tops is going to cost you more money because when you get the actual top, one, you'll either be defeated and have stopped trying, or two, you will guess it right, but you had 10 misses to get there, and so by the time you get back to making money on all the misses, you're exactly where the indicator would have entered anyway. Catching tops and bottoms is extremely hard. However, we think we've devised a system that does pretty good at it. If you look at this buy, I mean, these are pre-market. We don't take these, but it's still applicable. This buy is 3 bars off the bottom. This sell is the top. This buy is 3 bars off the bottom, and all of them are screamers. So the indicator's pretty darn good at finding the reversals. Still sitting on a 688 put here. I do like that we haven't gotten a put yet, and they've back tested the 8 because you're going to get a bounce off of the 8. Even though it's a small one, that small bounce is, it makes your entry suck, because if you get your entry right here at the 8 and then it does this, well, you could have entered up here, which is one of the techniques I use if you get the entry signal on a moving average, most of the time you can wait a second or two and get a better entry, because you're going to get a little bit of a bounce before it blows through, if it's going to blow through. Now, obviously, we didn't get that, but if you did, and if ifs and buts were candy and nuts, we have a lot of dumb sayings. I don't know if they're all American, but Americans use them. Like, there's many ways to skin a cat. My friend, I'm assuming from I lived in Kentucky a lot of my life. I'm assuming they're talking about skinning a catfish, because, as my buddy said, who in the hell is skinning cats? What kind of psychopath is doing that? Okay, we got the sell signal there. It's going to be 174 at the 688 strike. Our stop is going to be 689.65. And we are short here. See how it goes. It's Fed day. You get a lot of movement. We haven't tested the lower half of this overnight action at all, so hopefully we get a little follow through here. That'd be great. 17 cents is going to be 10%, so that's actually about 18 cents. So that's going to be 92. 192 will move our stop up 25 cents. Or down, I should say, 25 cents. This is going to be the key zone, right? Because you have VWAP, you have the 21, and then you have all three of these bars that were unable to get down below yesterday's high. And you have all of these wicks down here on today's open. So this is the key area. They will break down through that. That opens the door down to 688.28 and then 687.68 after that. So we'll see if they fail to break out here. That'd be really nice, because that gives us the full rundown. And we should break on down with that. Breadth has turned down again. It got up to negative 200. It's now back to negative 327, actually negative 335. Yeah, we've got things look slightly red, slightly bearish, but we still have to see price follow through. Remember, the market makers want to get back under this level. They don't like being above this level. It makes them nervous. All right, coming into key support here. Should see a little bounce. There it is. Hopefully not a big bounce. That's going to be the key. If it's not a big bounce, they'll get through. If it's a big bounce, we're probably going back up. All right, we just hit 192, so I'm going to move my stop up or down, I should say. 689.40 is now going to be my stop. So I moved it 25 cents there because we hit 10% profit. And what this does is limit our risk should they get that big bounce. Is it possible they can bounce it back up, hit our stop, but not hit the other stop and come back down? Yeah, of course it is. However, more often than not, when they come down into these support levels and start to get a big bounce, it's a momentum shift and they go back higher. So we are playing percentages all over the place. That's all we do. We are well aware that we're going to miss trades. We are well aware that they can move up and then fail again. All of those things are true sometimes, but more often than not, if they get to a 10% gain and then reverse to a negative or a green bar here, which is what would happen, it's going to stay green and go to the highs. You really want to see them stay below the moving averages here. They can back test them like they're doing now, but you really want to see them stay below. Once they start to get back up into the top of that candle that just went down, it becomes problematic for the bears anyway. Once again, not as big, not terrible, but you still got a wick off of support here. They're still unable to break today's open. And until they can break today's open, you're going to see these kinds of bounces. So hopefully they come down and break through here. That'll give us a decent win. Will, I got in at 174, but you got to remember, I see the trade before you because of the slight delay. So by the time you hear that there's a trade or see that there's a trade, you're probably a few cents behind. But I got in at 174 cost. So not too much different. A few seconds makes all the difference in uh, day trading because the market does move very quickly at times. Not always, but at times. Okay, we hit $2 there, so we're going to move our stops now back to break even. We're very close. I thought that spike down would have got it, but it did not stop or get my profit trigger. So we are risk free right now, guys. So our stops are at 174, price is at 191. I had 210 down here. I guess they didn't. I didn't register through. I never saw it on the screen, but sometimes those move so fast that they spike, run them through, and then and reverse. But unfortunately, I didn't get that. We'll see if they can hold and push down. If that's going to be the spike into test this low and back up. Have you ever used Thinkorswim's Elliott wave pattern recognition? Kind of confusing. No, but I found that almost all of the quote unquote Elliott wave automators are just awful. They're just awful. They have no concept. They break the rules left and right. Mm-hmm. A lot of fair amount of volume on that this spike down here. So hopefully the bears can find a little bit more follow through. Unfortunately, not unfortunately, we don't know, but on Fed days that's hard to do unless the trend is going to be, you know, up or down. So if they're going to trend up quite they can trend up into the Fed and then use the Fed as a springboard to have a really big day. They can do the same thing to the downside. So if the trend was going to be down, you know, they can come down. They're still in range. I mean, they spiked the pre-market high by a little bit here. So there's nothing crazy, still just choppy, which I warned about at the start of the day. So right now you had a spike of the open, and then 4 tries at the open, another try here, a spike, but they haven't closed below today's open yet. If they can close below the open, that can give the bears a little bit of downside momentum here. Really need Nvidia to slow down because Meta, Microsoft, Netflix, and Amazon have all turned red. Nvidia's kind of acting the fool over there, up 5% almost. So close, 201 here. Need 9 cents and we're out the door. Technically, mathematically 8 cents, but I like round numbers, so I went 210. Maybe that was the problem. If I had gone with 209, I probably would have had my first cash, honestly. Closed on the open there, but still not below the open. And that is the pain and the thorn in the side of the bears right now, is they just can't get below the open and sustain price. Maybe here. Fifth time's the charm. We are like I said, we're in a risk-free trade. Our stops are at break even. We're trying to get this downside to continue on a little further here to get our first profit take. If we can get that, that'll be a good start to the day. Always like a winner to start the day. But at worst, we're going to break even. So, well, now the ES is showing a squeeze building on the 5-minute chart here. So, we'll see in which direction that squeeze is going to play out. My concern, given all the wicks to the downside, is that it's going to be a bull squeeze. But we'll see. We'll see if yeah. See if the moving averages can hold here. I already took profit. I'm weak and scared. So that will destroy the model, Will. If you take profit early, you will destroy the model. So good for you for taking profit. You made money. Never, I don't know if Jim Cramer made the quote, but he uses it a lot. You can't go broke taking profits, but you're destroying the risk reward ratios. Just so you're aware of that. I don't want you to have some kind of false hope and then see it disintegrate if you do that too often, because the stops will kill you. When you get stopped out, when you're taking small profits, you're essentially 1-to-1 at that point, and you can't be 1-to-1 on your risk reward. I mean, you can be, but you got to be right a lot. Bull trap ahead of Fed? Maybe. I mean, they certainly can use a wave 4 before they get to 7,000, so I wouldn't be shocked to see a small pullback. But until I see something that isn't bullish, which is I haven't seen in a while, until I see something that isn't bullish, I'm not thinking the bulls are the ones getting trapped very often. All right, that's a good rejection of the moving averages. Now we need to see follow through. NQ's got a red bar. Let's make this one red. What I will say, though, George, is we are close enough to the 7,000 zone that the bulls could get trapped during the Fed and in the after hours earnings segment. Um, we've had two big earnings right now. Netflix and Tesla, both of them had red days after. Well, Tesla reversed. They went down 6% to up 6%. That was kind of a weird day, but their initial reaction was red. So you've seen the two bigger tech companies that have reported have red earnings. So if you have three red earnings today after the bell, you could see the Fed run them up towards 7,000 and then reject it after hours and trap the bulls there. I could definitely see that kind of bull trap. Ever do a win loss percentage on your trades? Meaning, is it 55% winners? Even just a few cents per trade would add up. Now, uh, I have before, and it was around 60%. However, win loss percentage is completely and 100% irrelevant. Does anybody know why? This is what becomes confusing for traders is they want to look at very simplistic numbers, and trading is not a very simplistic game. You can make it simplistic, but you have to understand what the numbers are to make it simplistic. So does anybody know why win-loss percentage does not matter? Alejandro just said yes. What, can you elaborate? Runners need to run. Not exactly, no. It doesn't have to do with runners. Bigger win, small lose, kinda. You're getting closer. Winners are big enough to recover all losses. Basically, you're getting there. So if you run a trading strategy that's 1-to-1, then win loss percentage matters, because if for every win you get 25 cents and every loss you get 25 cents, if you only win half your trades, you break even minus your fees, so you lose money. So you must have a winning percentage if you're 1-to-1. However, most traders aren't 1-to-1 on their risk reward. Most traders that are any good at trading are at least 2-to-1, many like 3-to-1, depending on what their style is. But if you're 2-to-1, that means you only got to win one out of every three trades to break even. Now you're going to lose your fees, but to get to that 50-50 mode is what I'm saying. Because if you win 50 cents each time you win, but you lose 25 cents every time you lose, well, if I lose two trades, that's 50 cents. If I win one trade, that's also 50 cents. So I only have to be 33% to break even. So 34% and higher makes money, roughly. Same thing with 3-to-1. I only got to win one out of four trades to break even. So your risk reward determines what your winning percentage needs to be for your trading style. So risk reward or trading percentage is irrelevant in the sense that if it's not over 50%, that doesn't make you not a successful trader. I know really, 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 really successful traders whose winning percentage is probably in the 40% level. Does anybody know where the best place to trap bulls and bears are? Just curious. This is not anything other than me being curious and asking you guys questions since we don't have a whole lot going on here as we wait for this trade to try to play out. How about this? I'll give you an option. Do you think that this is a good place to trap the bulls? What is a gamma wall? I explained that earlier in the video. If you want to rewind, you can go find it. Quick synopsis. This is where the highest level of 0 DTE options are. It's where the market makers want to defend very strongly. Gamma is what pushes the market higher faster. And when you get through this level, it causes a squeeze because the market makers have to defend and rebuy their positions. But you can go back and get a more complete explanation of that earlier in the video. Do you ever chart the actual options price and put the indicator on it? I don't know what you mean by that, Will. I use Discord for my trading journal. I chronicle all of my trades in there. I go back and check them every day and look at them. We compare when we got into trades and why, what the indicator was saying. We try to make it better all the time. Um, so I have that kind of after the bell kind of stuff, George. If the option price moves fast at the signal, do you skip the trade? It depends on how far away I am at the time of the signal, but most of the time I can get in pretty decent. But if I have to try more than twice to get my price, in other words, if I put in a price and obviously it's already moved past that, and then I put in another one and it's moved past that, then I'm out. So back to the question of where to trap or where is a good place to trap. It's past the lines. It's not the lines themselves. They can be a good place to trap. They're going to reject those lines pretty regularly. But when they really want to trap, they're going to go past the wall, get especially past the pre-market high like they did here. This gets everybody on board. So we've eclipsed the gamma wall. That should create a squeeze. We're over the pre-market high. That should create a squeeze. And that's when the bulls start to pile in momentum and breakout, and then they get trapped. Now, whether this trap works or not, we'll see. But these are called liquidity. This one's not yet. This is not one. Liquidity sweeps, though, or when you see those big spikes up like this, looks like they're going to break out. Everybody says, oh my God, look at that, get long. And then they do this. And then they do the same thing to the downside. They go down below resistance. Everybody's like, they broke resistance. Look at that bar. They're going to go short. And then they do this. Those are called liquidity sweeps, and that's how they trap you. And that's why entering shorts late is a trap. Entering longs late is a trap. I hate the breakout buy personally. It's not my style. I like breakdowns and reversals because you have much more reward and a whole lot less risk. Because if I was going to go short here, I have a very clear entry and a very clear stop. If I was going to go long here, up here when we got here, well, I have an entry. Where's my stop? All the way down here somewhere, I guess. You know, you have to, and on a more clear breakout, this was a choppy breakout, but on a more clear breakout, if I enter right now, where's my stop? You know what I mean? So I don't have anything to trade off of. Now, if they do this, something like that, and they break up above that, then you can enter long here and have this as your stop. That's a much better way to trade. But if you're just trying to trade straight breakouts, that's how they trap buyers and sellers the most is they do that. We missed our stop here by just 2 cents. They got down to 176. We have 174. So hopefully they don't stop us and they can we can try to get this cashed in right now. Get just a little bit of downside momentum, we'll make some money, and a lot of downside momentum, we'll make a lot of money. You got stopped out, Will. You had 178, so if you were break even, I get that. I saw 176 as the low. Got a little something out of it. You did, Will, and I'm certainly not gonna complain that you made money. What I am gonna tell you is that that style of trading will cost you over time. Remember, it's not about any one trade; it's about the whole conglomerate of trades. I use OCOs, Maxime. This has been the most lackluster short of all time. So this was my warning at the beginning of the stream. Very, very likely that uh, we get a slow, choppy day into the Fed, that we're not going to see any crazy moves. Hopefully they give us a little bit of a spike down here to get out of this trade with a win. But worst case scenario, we came, we saw, we did nothing. We didn't lose, didn't win, didn't do anything. What is your opinion in trading in November and December? Um, I think it's fine. The difference for me is the indicator is very volume based. Um, it has a heavy reliance on volume at certain levels. And when you get holiday trading, you get a lot less volume. Um, just in general, the second half of November and all of December, people are taking Christmas breaks, people are taking Thanksgiving, people are traveling, people have kids home from school. So you have a lot less trading in the retail world, you have a lot less trading in the institutional world, you have a lot less trading on Wall Street. Um, because of that, the indicator, we haven't been able to fully figure out how to manage that switch. It's done better, but November and December are typically our worst 2 months of the year for trading, um, because the indicator sees low volume moves and assumes they're weak when that's just the volume of the time. So it's been a complicated process of trying to figure that out. But as far as regular price action trading, if you want to do that, generally it's fine. Remember, the market doesn't move on news. It, let me rephrase that. The market doesn't move based on the tone of the news. In other words, if we get good news from the Fed today, that doesn't mean the market's going up. If we get bad news from the Fed today, it doesn't mean the market's going down. Because for one, you don't know what companies consider good or bad news. For two, the market already knows this stuff. They there's like a 85% that he's going to cut rates today or something. I don't know, whatever it is. Um, what the market doesn't like is uncertainty, and that's where the market starts to have some issues because it tends to know what's going to happen before it happens. The market's very, very forward looking. So it understands that inflation is coming. So when the inflation report in 2022 is the highest in 7 decades, and the market has the biggest rip it's had in the history of the market, that's because the market doesn't care about inflation because it already knew about it. That was part of the reason we went down in 2022 at the start of 2022 is inflation. And they knew that it was probably peaking and everybody else was panicking and they were buying. So the market doesn't care what the news is in the sense that you think it does. That's why they call it the wall of worry, because everybody's like, "Whoa, what if Netanyahu or whatever is how you? I don't know how to say his name. I'm not trying to offend anyone who's from Israel or Jewish. Ben Netanyahu. What if he starts the war up again? What if this happens? What if Trump does this? Doesn't matter. The market doesn't care. The market can do what I call ants marching. So, for instance, Trump may tweet that he's not going to talk to China, and the market goes down 3% that day, which it did, what, 2 Fridays ago? Or whenever that was. I think it was 2 Fridays ago. The market was already on a march toward this goal. So if you think of ants marching in a line, they go from their hive to the sugar back to their hive. Each way, they pass the word down to the next guy where the sugar is. He goes and gets it, and they just go back and forth in a line. Now, if you come in and put a stick in that line, you'll see a disruption of the ants. They will scramble. They will run all over the stick. They will go around it. They will go sideways. They will go any way they can to preserve themselves in the hive. And then they will adjust to whatever the stick is. And then they will just go over the stick and to the sugar, or around the stick and to the sugar, and still get where they were going. So I call that ants marching, because the market can flip out for 10 minutes over a Trump tweet or over a news event or whatever, but it's still going to where it was going. It's not going to crash because Trump tweeted something. It's not going to the moon because they're going to cut rates today. It's just going to do what it was already going to do. Are you going to see some wild behavior this afternoon? Is the market going to go up and down and all around? Probably. I mean, it could go in one direction, but generally you see two-way movement. So don't ever let the news dictate what you think about the market, because it's irrelevant. It's a very irrelevant thing, and I can give you, I don't know, 1,000 examples of that. The most relevant and recent being COVID, where in March of 2020, the market dropped however many percent it dropped down to the 2000 level. The world was freaking out. No one knew what to do. There was no vaccines. There was no uh, clue what this was, how it worked, if it was going to be deadly for everybody. No one knew what was going on. They were putting people in their homes. They shut down the Las Vegas Strip. Businesses were going out of business at the speed of sound. We were printing money at the speed of sound. And the market turned and went up as fast as it's ever gone up, into the face of the worst unemployment, the worst economic status, the worst uh, um, news you could possibly get in the modern era. Now, have we had other pandemics and stuff? Sure, but not that did that. As the first time in the history Las Vegas Strip has ever been shut down. It was really weird, right? Me and my wife riding our bike up there with boarded up windows on giant casinos and stuff. Very strange thing. Um, so the market, in the face of that, railed higher and didn't care. And you're going to tell me, yeah, but the Fed tried 4 times to stop it. 4 times. And on the fourth time, the market magically said, hey, we're going to go up. It must have been the Fed, right? Well, what happened the other 3 times? And if you look at the chart, all you have to see is where support was. And they came down to support, held support, and went higher. So uh, anybody who was tracking the market with Elliott wave theory at that time, myself being one of them, was looking for a pretty substantial pullback in that time period. And the market kept raging higher, well over 3,000, 3,300, I believe, is about where it topped, before it turned down. And then it turned down in a vicious way because it was a C wave. Long story short, my point is the news, COVID, was as bad as it could possibly be at the end of March. And the market rallied stronger than it ever has. So if you want to talk fundamentals, that's important for businesses to stay open and keep going. If you want to talk news, that's important for people's livelihood and their work and things like that. But if you want to talk stocks, the news is 100% irrelevant. Ooh, we're real close. Come on, Bears, you're almost there. 208. Hey, we got it. All right, we're closing half at 210 there. My goodness, that took forever. All right. Now we're guaranteed a 10% win. That's good. So it does look like the squeeze is playing out to the downside. That's a positive. You have it on the NASDAQ as well. It's a 5-minute squeeze, so that doesn't. That means we might go test the pre-market low or something like that. Doesn't mean we're going to break down. It can mean that because squeezes build upon themselves, but um, keep in mind this isn't like a weekly squeeze where it's getting ready to fire and we're looking at hundreds of points. This is just a 5-minute squeeze. Now they are coming into today's low, which will be a key level for the bears to get through, but I will not take profit there because we just took profit. We're only a few pennies higher than where we took profit, so there's no sense in taking another leg of profit here. Um, what I will do is look for here to take my next profit, which is the pre-market low. If they can get there, of course they have to get there, but assuming they can stretch it down there, that's where I would look next. And then yesterday's close for the gap fill would be the next target to take profit. NASDAQ is still pretty strong. It's mostly gone sideways to up. It's actually still in a weakening buy cycle. It has not moved into a sell cycle like the ES has. If we look at the NQ, you see the move you have there uh, from the open, which was right. The open was right here. They're still not even below today's open, whereas ES has gotten below today's open. However, I like this. This is looking good. Keep on keeping on, guys. So this is an iconic bull trap. Now, it's a short-term, quick bull trap. It's for day traders, but they have them on swing trades and dailies and stuff like that. But what you had here is you had a breakout attempt. See, you had these two highs right here. They got above them. They got above the pre-market high, and then they failed. And this is a failed breakout, and that usually turns into a pretty strong, semi-strong selling event that comes back to the pre-market low, which is 687.68, and potentially even the true pre-market low, which is actually down here where the market bottomed at 686.65. So I would expect them to hit 687.68 at some point. But this is why reversals are good. When you get a breakout and then you get the breakdown, that gives you the sell signal. Same thing to the bottom. When you get a failed breakdown, they go below the pre-market low, then they turn and you get a buy signal. This is what you're. Where's my stop loss now? It's still at 174. It doesn't change. So 174 was my entry price. 174 is my stop loss. Once we get to 50 cents above that, so that would be 120 or 224. At 230, I will move it to 180. At 240, I will move it to 190. At 250, I'll move it to $2, and so on. I keep a 50-cent trailing stop. except for, so when we take our first profit, the stop is just where we entered, and we're guaranteed a 10% win at that point. But as price moves down, I trail at 50 cents to give them a chance to have little bounces in there that don't stop us out and continue the move. And then we take profit at the next key levels where we could see bounces. Do you follow any Elliott wave technicians like Prechter? No. I've read, obviously I've read his stuff, but I don't follow him current day. Um, Avi's really good. His stuff's really good. I don't mind him. I just don't like his personality is a little rough for me. He's a little abrasive in my opinion, but his stuff's really good. He does good work. Or Avi, I don't know how you say it. I'm not very good at names. Might be Avi. The wave count is we're in wave 5 right now. This is our live call, so we don't go through a ton of that. This is just more of a sample of the indicator and where we're at. I was a little late getting started this morning. Sometimes I go through it in the morning before we get started, but we're in wave 5 of 5 of 5 of 5 of 5. I think it's right. It's a lot of fives. Um, and whether this is the top or not is to be determined. I think 7,000 is a very likely target on the SPX, which is about 7. What did I say it was? We're about 32, 70, 32 on ES. I think there's a fair shot that we get there today with the Fed or after hours with the earnings. But what we could be seeing here is the start of a wave 4. And the Fed could push us down a wave 4, and then earnings take us higher. There's, like I said, there's a lot of options. If you got here late, you can go back, and I went through a bunch of options on how we can get to 7,000, but there's a lot of ways to do that. I guess the ultimate trap, though, would be coming up just short of 7,000 and turning it down where everybody's trying to stay long until 7,000, and then you swipe them. So, however the market's going to make the most money, that's what they're going to do. What time is the Fed cut rates? 2 p.m. You're assuming they're cutting. They're not guaranteed, but that's probably what they're going to do. But it's at 2 p.m. So we're going to move our stops to 190 now. We did hit 240 on the way down there. We're real close to it. I'm going to go ahead and move it up because this is a good area for them to bounce. So our stops are at 190. So a failed breakout brings us back to the pre-market low. I still think they'll touch this number down here. This is very likely a stop run before they come down and hit this number, or a trap for the bulls, one or the other. If not, then they came up just short. That happens. Certainly not uncommon. There are 3 ways they can get to a support or resistance level. They can come up just short of it and turn down. They can hit it on the number and turn down. They can spike through it and turn down. Those are all holding support or resistance, depending on which way you're going. In this case, they came up just short of where they were headed. I still think they'll touch this number because that's what happens when you get failed breakouts. You hit the pre-market low. But occasionally they do this, and it's close enough for them. If you're not already, guys, don't forget to go follow me on Instagram. I do a morning update every day. I usually give the key levels for one of the markets and a trading tip. I also do that on YouTube as well for the shorts, but on Instagram I try to do some other different things with my stories during the day, kind of give some updates on the ADD or what I see in the market, those kind of things. So if you want some extra information than I give in just the overnight video, check that out. That is all, of course, free. Um, so far, as long as they hold the 821 or VWAP, so these three I have on the chart here, this continues the trend to the downside. Now, we're not in a trend day yet because we haven't broken the pre-market low or the true pre-market low, which is down here. So the pre-market low that I use, I really like this key levels um, indicator, but it gives you the pre-market low from the true pre-market of the SPY, so the yellow part here on the screen, when the actual pre-market low for me is over here at 686.64. This will be a key level. You can see they've already bounced it once. They set it, they came down and bounced it. It'll be a key level, but so will this level down here. And this is the one they really need to break to be in a trend. These are the things that define gaps better. So this is important to understand the concept. If you don't understand how gaps work or the importance of a gap, so you have this level down here, and this is your close right here. So this is your close. They can gap up to here, and that is a gap up, right? They actually gapped up to here. Well, they opened here and then moved. But this is not what you would call a true gap in the sense that a true bull gap. They didn't gap back over the high. They just gapped back up the range. So this gap is less powerful than a gap that opens up here. So when you see a gap that doesn't open in above or below the high or low from the day before, in other words, it's just kind of gapping into the range, that can be the start of something good, but it is not nearly considered as significant as a gap that actually gaps up over yesterday's high. All right, they're trying to reject the 8 here, and they bounce back to it off of the pre-market low, or close to the pre-market low. Hopefully they can reject the 8 and continue this wash to the downside. Since we have not stopped out yet, we would like to maximize our trade as much as possible. Does anybody have any questions about anything while we wait? I'm always happy to answer questions on these. That's what I'm here for. Help you guys out, answer questions, trade, show you the indicator. 30% off the indicator, by the way. I didn't go over that at all. Coupon code's on the screen. Make sure you enter that coupon code when you sign up, and you'll get 30% off the first month. You also get 30-day money-back guarantee, and that's because I stand behind everything I do. I'm a pretty upfront, honest, stand-up guy. So if I say something, I mean it, and I love and trust our indicator, and I think you will too. But if for some reason you don't, then you get your money back as long as you let me know within 30 days. What I always tell people, if you're on the fence or you're wondering about it or you don't believe it or anything, simply get it, put it on your chart, and watch it. Don't trade it. I don't want you to put any money at risk. You can either paper trade it or just watch it. And if it does what I say and you follow it, follow the instructions that you get, and you don't like it, I will give you your money back, and you have risked zero money to check it out. You have no risk whatsoever. If you love it, which I think you will, then you keep it, and we both, get to enjoy making money in the market, and you get to enjoy a very simple way to understand the market. The market is very confusing. It tricks, traps, fools people, as the late David Frost would say. What's he call them? The trick, trap, fool, and frustrate crew. That's the job of the market, to fool as many traders as possible so that the money can keep flowing. And what we've done is simplify all of that and put it into a place where you can enter and exit the market with very clear lines and make it so that trading becomes very robotic and simple. We try to remove all emotion from trading, because emotion is the devil as far as trading goes. Emotion is for dating, not trading. And to sum that up, if you think about dating, if you think about girls or boys that you've been with and lost and were sad about it or mad about it or angry about it, if you think about the dumb things you've said or the drunken phone calls you've made or the ignorant things you've done out of emotion, you'll understand why emotion is the devil in trading, because it makes you do things that are out of character. It makes you do things that aren't you, and it makes you make really bad decisions a lot of times. So we try to take emotion out of trading by giving you a clear buy and sell so that you can become a winning trader like we are, and you can make money in the market with a simple, easy to follow process. If you've ever thought the market is rigged or stacked against you, it's because you, no offense to anyone out there, you likely don't understand the broader picture of the market and how it moves and why it moves the way it does and what the purpose of the moves are. The moves are exactly to make you think it's rigged. The moves are exactly to make you frustrated so that you'll do more emotional things and put more of your money into it in a bad way. And the indicator fixes all of that if you simply follow the rules. And that's really a harder thing to do than to say. If you think about losing weight, following the rules is simple. Just eat less. All you got to do is eat less and exercise more. Those are the two rules. If you follow those, you will lose weight. But it's really hard to do because your emotions play tricks on you. Your emotions fool you into thinking you're bulletproof. Your emotions fool you into thinking the market is rigged. Your emotions fool you into making bad decisions. And that's what you need to eliminate. And that's how we try to do it, is give you something that tells you exactly when to get in, exactly when to get out, and make you a better trader. So check it out if you haven't already. It is, like I said, 30% off right now for the first month, and then regular price after that. And then if you get the yearly, you get 2 months for free. You get the 30-day money-back guarantee, and you get both Elliott Wave courses for free. I have questions on stops because the stops, well, we are in profit. I don't know exactly what that means. When we hit our first profit targets, where do we adjust the stops? So I went through that maybe 10 minutes ago. You keep it at break even. So right now my stop is still at 170, or actually it's up to 190. It was at 174, and on the spike down right here, we got to 240 or so on the options. I keep a 50-cent trailing stop. So when we took profit at 210, our price was at 174, so that's only 36 cents. When price got to 50 cents, then we were in our zone to start moving the options stop up. So when it got to $2.40, you take 50 cents off of that, and that makes your stop $1.90. Has any company tried to buy your indicator yet, like a hedge fund, etc.? No, not yet. I'm not. I don't think I'm on the map enough for them to know it's out there. To be quite honest with you, in the big scheme of the YouTube world, my following is pretty small. Um, I do really well with it. I mean, I have 600 paid members in my rooms and about 400 people using the indicator, um, which is a really nice business for me. But in the big scheme of things, I don't think that they know I'm even out there, honestly. What is your thought on RTY going positive? RTY is a good supporting evidence indicator. We don't tend to trade it, but we trade the SPY and the NQ, and I specifically generally only trade the SPY. I added the NQ a few years ago because people were asking for it. But the RTY, when it's green, it's going to be awfully hard for the markets to fall off a cliff. If the RTY is doing the opposite thing, so let's say the RTY is red and the markets are green, it's going to be very hard for the markets to run away without the RTY participating. Vice versa, if the RTY is green and the markets are red, very hard for them to fall off a cliff if the other markets aren't participating. My overall thought is we're headed to 7,000 one way or another, whether that's direct or not. Um, the more green the market is right now, kind of irrelevant with the Fed. What it's doing right now is irrelevant because we haven't done anything. We're inside of the pre-market high and pre-market low. We're just in a range. And this is kind of what I said would happen at the start of the day. We'd be in this range most of the day until the Fed. And it'd probably be slow and not to overtrade it. Um, so, it's I mean, it's definitely a positive for the bulls to get it green and solidly green at that. It's a 0.5% green. The ADD has improved. It's minus 169, but still negative. Um, it needs to be, like I said, negative in the 100s and positive in the hundreds isn't that big a deal. 1500 negative, 1500 positive. That's when you start to see real big moves happen. So right now, everything's just kind of sitting in a flat zone of slightly bullish overall, but nothing crazy. The one I'm watching is this one. I've mentioned more than once that banks have major problems, and if banks start to fall through the floor, the market will instantly follow. The market cannot win without banks. And the banking sector, I think, is in much bigger trouble than people realize. Like physical banks are in trouble. I still think it's astonishing that two of the five biggest banks in the world went out of business in the last few years and nobody cares or nobody's writing about it. They're just saying, "Oh yeah, they went out of business. That was weird." Yeah, and then Tricolor goes out of business and there are billions of dollars in auto loans, and the corporate mortgages are absolutely screwed. The auto loans are absolutely screwed. The credit cards are absolutely screwed. The shadow banking is an absolute train wreck of equity that banks can't handle. I think that it's a fair assumption that a fair amount of banks are going to go out of business when the shoe drops. Um, and that will be a nasty financial crisis, way nastier than 2008 and 9, way nastier. Do you think crypto will have a blow off top in the next couple months? It's possible. Bitcoin's in a very interesting state. I haven't looked at Bitcoin today. Where are they at? They're at 112. So they got back to that 115 zone. They are in a very precarious position already on Bitcoin. They can certainly go back to the highs. I have 140 as their next target if they do break out. Um, but they got to get above 118 for that to happen and sustain above 118. If they can get above 118 and sustain above 118, we will look for them to go to 140. But they are in a potential Wyckoff distribution right now, and if that last leg drops, they will be down at 70 in a blink. 50-cent trailing stop even when IV and option prices are elevated. For the most part, yeah. I mean, they got to be really elevated for me to change that. But on those really elevated days, I trim my positions down to halves or thirds. Like when we were in April, I think it was, the options prices were like $7, which is outrageous. Um, the cool part about today is you don't, because all of the action is happening in the afternoon, you don't get the theta loss in the same degree you would on other days because the implied volatility is all the way high throughout the day. So we're able to sustain this 190 stop loss for quite a while. They still haven't stopped us out on that. And if we can get another push down here, we'll do really well on the trade. If not, then we'll stop out, and it'll be what it'll be. We'll make 10% on a pretty choppy day and be happy with it. These are things to watch. When I say breadth is bad, this is what I mean. So RSP, if you don't know, this is the equal weighted S&P 500. And what that means is they take all of the stocks in the S&P 500 and weight them equally, whereas the actual S&P 500, the Mag 7, is very heavily weighted, and makes up a big portion of the strength of this S&P. And so when you evenly weight them, breadth is not doing as good. I mean, it's not like it's getting killed. It's down a third of a percent. But my point is, the market is red when you evenly weight things. When you don't, and you give power to the people, when you give power to the Mag 7, stocks like Nvidia can have enough strength to carry the market. They are coming off that 5%, though. That's good. I said if Nvidia could come down a little bit, we'd be all right. What's my opinion on the Argentina banks? I got to be very honest. I don't have an opinion because I don't know anything about them. I can't speak to things I don't know about. I know about the American banks and what's on their balance sheets, but I can't tell you what's going on with those. One thing I won't do is make stuff up just to appease people. If I don't know it, I'll just tell you I don't know, because that's not fair to anyone out there to say something that is made up. So if you ask me a question, I don't know the answer, I'm happy to tell you I don't. I'm not happy. I don't like not knowing things, but I will tell you I don't know because nobody knows everything about the market. There are 70 trillion things you can know about the market, and I focus on a very small window of things that I think are very important to the market, and more specifically, the American markets. But things like currency, I don't keep up with them at all. I don't have any interest in currency. I don't talk about them. I don't chart them. They are a mess. The currency exchanges and stuff. That's something I'll rely on other people for should I need information on it. So here's the thing: they came down here, they spiked this area, they got close to the pre-market low, and then bounced. Typically, that's gonna. So I do expect if they come down again and break this low, that the pre-market low will probably, of course, produce a little bit of a bounce, but ultimately they're going to go for a gap close. I think if they break lower, they still got to break lower. But if they do break lower and get below this low right here at 687.80, I would say that 687 or 686.97 has a real good shot of getting hit. If they don't, then they're going to push this back up and take it on out of here. So there's a concept I can go back over. If the stock, so there's two concepts here. One, first time, best time. The first time they come into a major resistance or support zone, either one, but in this case resistance, first time is the best time for rejection. The reason is that's when the most people are sitting there. That's when the most people are trying to short this area. That's when you're going to have the most follow through to the downside. That doesn't mean the second time you can't get something like this and still make a little bit of money on a short, but it's first time is usually your best time of breaking down. The second time up, you got less people there, you know, the wall is weakening, and that means the push down will weaken as well. Now, if they come up to this area and they don't quite get there, and it's a key area for them to hit, like the pre-market low, for instance, they came real close. So if they get up here and they don't hit it and they pull away, that's considered first time. They got there. They got rejected below it because they kept all of the guys sitting on this number out. That was a trap or a trick, if you will. So they kept everyone who's long from getting here and closing out, and they kept everyone from short from hitting that number and shorting. So they got there, but the reason they did that is because they want to come up again, and now everybody says, oh, they're here, we can reject, and then they do this. Okay? So when they get close, typically it means they want to go further. Until or unless they show you that the trend changes back to the upside. So right now the worst we can do on this trade is get out at $2. We took profit at 210. We have a 190 stop. Those two halves average out to $2. Um, so that's certainly a decent win on that trade, and that's the worst we can do. We got in at 174. That's a 26-cent win. And while you may say only 26 cents, that doesn't seem like very much. That's like 15%. You're right, it is only 15%, but we trade 50 contracts, and 50 times 26 is $1,300. And if you made $1,300 every day you traded, you'd be a pretty happy person. So 26 cents is perfectly happy for me. Now, you don't have to trade 50 contracts. You can trade more or less depending on um, what your capital can handle. If you're an account that only has maybe 20,000 in it, you might only want to trade 5. If you're an account that has 500,000, you might want to trade 100 or 150 or something. That's up to you. That's not for me to decide. But um, I'm just giving you the example of what I'm trading and how important that is to my overall account. That's a very big deal. If you made 15% every single day on the money you risked, you would be a very, very, very happy person. JPO, welcome to the stream. Tim, welcome to the stream. Thanks for commenting, guys. Appreciate you being here. Alejandro, welcome to the stream. Dominic, appreciate all you guys being here. Thank you for hanging out. Looks like we're probably going to push here. If I had to guess, you have a long wick down, then you have a push down that failed, a green, a wick, and a wick now, and this one's turning green. So bears are looking like they're running out of steam here. Momentum is dying. I would not be shocked if we got a buy signal here shortly, which means I need to get ready for that. Slow moving, that's for sure. Mag 7's starting to fade. It was pretty green early in the day. Now you got Meta's red, Microsoft is red, Netflix is red, Apple is red, and then even though they're not technically a Mag 7, Tesla is red. So you're starting to see some fade here. Nvidia kind of pumping up that sector pretty strongly. They were up at around 5% before, though, now just at 3.9. Just at 3.9. Pretty good day for Nvidia. Got over that $200 barrier I've been talking about in my room for a while if you've been in there. Actually jumped it pretty good. I was looking at 205. They got to 210 today. Pretty big jump from Nvidia. Okay, there's our buy signal. So we close out our trade at 198. We are buying at 199. How convenient is that? 198, 199. Our stop is 688.07. Ugh. So our average exit on that first trade, guys, was 204. Now we're in the second trade here. We'll see how this buy signal goes. Hopefully they race it on out of here. Don't want to see them fail VWAP. That wouldn't be good. Ugh. So right now we're in at 689. We have a 199 strike cost. A cost, I should say. 689 strike, 199 cost, 688.07 stop. If I'm being honest, I don't love the entry. The only reason is this call resistance here. They've been beaten on it. I mean, they got above it immediately, failed, got above it, failed, got above it, failed. So if they keep the trend alive, we're going to get above it again. But you don't have a ton of room here to get up to it. So I don't love the entry. I would have liked to have not seen it play out, honestly. But the indicator is smarter than me and can look at a lot more things than I can simultaneously. Ugh. JG, you mentioned 26,600 off of NQ off on NQ, but that would be after a large wave 4 down right, or are you thinking it could go straight there? Also, shouldn't wave 4 enter wave 1? So, uh, no, because we're in a C wave of that's the diagonal is the ABC, and the C is the part of the diagonal. We can definitely go straight to 26.6. If the Fed blows through the top today, then that's a very real target. Um, we don't have to pull back first. Wave threes can extend, and that's just you know how it goes. But 26.6 is assuming they can get through. What was it? The 26,309 area. And they're below that now, so they got to get through 26,309 strongly, and then they can squeeze. But until then, they are. We could see them pull back, but it does not have to get into wave one territory. You send your opening trade, then send your second trade and first take, or how specifically do you do it? So my OCO is on the initial. It's on the 50, if that's what you're asking. And then when we move stops, I do it manually. And welcome to the stream, Prabs, Johnny, Katz, Green. I'm normally entering bracket, but you can't change the contract amount because it's linked. Yeah, that's so. Normally I do the brackets for the initial trade where my stop is X and um, my take profit is Y. I think they're going to hold this up until the Fed. They could. Like I said, this can be a very choppy day, and until the Fed, and then it'll be wild. Ryan, welcome to the stream. You said KRE. Uh, I don't know if you want me to look at KRE or if you're just. We're about to stop out here. It looks like. Let's see if they can hold this low. Are we not in wave 4 of 3? Potentially. We haven't confirmed that yet. We're not down that much. I would probably call it wave 4 overall, actually, though. John, going back to your question, I think I understand what you mean now. Sorry, I was rereading that. So I use OCO, but I use the half. Um, so 25, right? And I can take profit and stop loss on that, and then put in another 25 at the stop loss. So I have an OCO for half the order, and then another stop loss for the other half, just on the bottom side, if that makes sense. So I put in an OCO for 25, and then I still have 25 contracts unaccounted for. You take the other 25 and you create a stop loss for those. That's just a separate standalone order. Hopefully that makes sense. No, I'm saying the small caps IWM is the key to the grand super cycle. Being over as it holds the regional banks. Yeah, I mean the banks in general, XLF, KRE, yes. Um, those are. We stopped out there, by the way. 183 guys on the stop out. Sorry, we got stopped out, so I got sidetracked there, Ryan. Yeah, I mean, I don't know that RTY itself holds the key. The banking sector, I do think, holds the key for sure. That was the Instagram, the reel I put out yesterday when I was asking what sector controls the key to the market. We're gonna try one more buy here, guys. We got it at 191. And 687.75 is our stop. Give it one more shot here. If this one actually, I want to move my stop down just a little bit because of the pre-market low here. So sometimes you got to use a little common sense. So we're going to go 687. We'll go 62. 687, 62 for the stop. It's a little deeper than I would normally go. Not a ton, but, that pre-market low should hold or should be effective if they're going to hold it. So we want to give them a chance to. We just took a long will. So this is what I mentioned earlier. This number is likely to get hit. Might be going beyond it based on the overall structure here. But when they break down from the high, they're going to hit the pre-market low 9 out of 10 times. So we did put our stop just below that to give them a chance to do this. We'll see how it goes. The ADD is continuing to improve. It's all the way up to negative 15. Remember, it opened at negative 450. So it's almost turning positive, which is a bullish sign in general. We'll see if they're able to hold this low or not. You too. Can you look at the UVIX with the indicator? I can in a little bit, Ryan. We're in a trade right now, so to change the charts over, I have to do some work on that. So once this trade either stops out or we get to a place where I can have some breathing room, I can do that. So we got in at $1.91. That means 10% of that is 19 cents. So that means that 210 is where we move our stop up. No problem, Ryan. As soon as we get some kind of movement here, we can go take a look at that. I'd say it's higher today. We can go look at the actual VIX here real quick. Over here. Just because it's Fed day, you're always going to have higher volatility. Where's my VIX? Right here. Yeah, it's the actual VIX is up 1% right now. Nothing extraordinary, but the volatility doesn't really hit until later this afternoon. We can see it climb into that. Do you measure intraday micro fibs for trading off of to complement the indicator? No. My Mentor Q levels are much better than the fibs. Fibs are really good for kind of longer term stuff, but and they're certainly not bad for short term. Don't get me wrong, but the Mentor Q levels are significantly better in my opinion. And then the pre-market lows, the opens and closes for gap fills, the averages. I mean, all of the stuff I have on my screen is what I use for intraday because I personally think it's a lot more valuable than fibs. They certainly have a lot of value in ABC type moves where we hit the 1.0 for profit taking, things like that, especially if the 1.0 aligns with a call wall or a put wall or something like that. But personally, no, I don't use the fibs in intraday. One, it gets my chart really messy and I don't like it. I like a cleaner chart for intraday anyway. And two, I use the other levels I have on here that I think are um, personally I think are just as good, if not better. And welcome to the stream, Dennis. You know, Nasdaq with all its bullishness, and it still is bullish. Don't get me wrong. Is the one who's the fly in the ointment here on this trade. ES is um, doing fine here, trying to consolidate, build a base, and push. Whereas Nasdaq is still sitting on its lows and trying to make another new low here. So that could be a fly in the ointment of this trade. This red doji you see on the SPY here is actually a retrace candle down to the lows on the Nasdaq. The ADD is now positive 42, so breadth is continuing to improve today. That's pointing toward a potential bull squeeze later this afternoon. Potential that can breadth can change in a snap of a finger. So if the market's getting ready to move down, they will hammer it, and then positive 40 will go to negative 400 and one negative 1,000 in a hurry. But the indication pre-market or pre-Fed is that they are buying stocks and turned it from a negative 450 to a positive 40. So there has been some buying of um, broad-based buying today. Man, the slow moving market. Dull. Guess I should have stayed quiet. As soon as I said it was dull, they gave us a new spike down. Thanks for doing these live streams. No problem, Will. I'm happy to do them. Trying to build a trading community of successful traders. And, it's always better to have community when you do things. Doing things by yourself is one, lonely. And two, you don't have the accountability factor, in my opinion. There's a lot of studies that show that if you surround yourself with better people, um, the group will rise up together. And so, if we can build a group of very solid traders, and I can teach you guys to understand the market better, then that makes me happy. That makes you guys happy. We make money. That makes all of us happy. And we're all just a big, dumb, happy family. So I'm happy to do them. You should live stream the statement and pal. No, uh, I'd have to have a censor. I cuss too much when he talks. He really rubs me the wrong way. He's either a giant liar or he's an idiot. Maybe both. But I don't like people, especially people that are quote unquote in charge of the economy, just that come out and just tell lies. Um, the whole inflation thing drove me nuts. Oh, there's no inflation. We don't see inflation rising. It's transient. It won't be here long. Inflation, blah, blah, blah. Either you're an idiot, because anyone who understands basic economic theory knew that was coming and coming heavy, or you just lied to keep everybody at bay until you had to say it was here because everyone could see it on their grocery bill. Either way, that doesn't make me a person. That doesn't make you a person I want to be around or listen to. So I would be need to be censored if I live streamed him. Maybe I could do it like Mystery Science Theater 3000 and make fun of it the whole time or something. This will be the last trade either way. This market just isn't moving enough for me to um, want to continue to try to trade it. Fed days in general aren't that great to trade. They're like this, choppy or trendy. They're either one or the other. They're really slow and choppy, or they're making a big move for a reversal or a continuation. And in all of those cases, it's difficult to trade them. So, if this stops out, so be it. If it wins, so be it. But either way, this will be the last trade of the day because Fed days are just ones you kind of want to sit out more than you want to be in. Unless you're a gambler, then you can take a bet on what you think the market's going to do this afternoon. But that's not for me. If you are curious, there are some cracks in the foundation of the market. Not big enough yet, I don't think, for today to be any kind of wipeout, but I mean, those are certainly things on the table. I don't think the market's wiping out before 7,000. That's just too close and too pretty. Um, so they can certainly pull back to 6,800 or something, 6,850, and then go tag it. But I think they're going to go tag it. Maybe they tag it today, maybe tomorrow, maybe not at all this week. I don't know. But I do think there are cracks in the foundation. I do think any dip will get bought. I think you could see one of those days today where you might see a spike down and then a bull rush. But I wouldn't be necessarily looking for a wipeout unless if they got below where are we at right now? I think 6,900 is yeah. If they got below 6,900 on the ES, I would want to see how they react. If they get below 6,900, so let's just say that this line right here is 6,900. If they get below 6,900 and then immediately back above it, I would be thinking something like this. If they get below 6,900 and they do this, then you could have a chance at a bigger move down that might just fail and be a red day. So we have to kind of see what the structure is once he starts talking. But I don't think that downside is heavily prevalent. I do find it a little interesting. We're at the call wall here, but if they get above this, they're going to squeeze. The 1-day max has got plenty of room. They can go all the way to 693 today. That's about 5 points up, so 50 ES. That gets us to 69.87. That would make sense. The caveat, the one caveat, I did mention to my group that when the ES gaps up, so let's go to the ES real quick. When the ES gaps up like it did the other day, the ES on Monday, the ES doesn't gap very often. It does it it does, but not very often, where it doesn't fill that gap. Where is that? Is that all the way? What was Sunday? 27th, I think, right? All right, let's do this so I can see the chart a little better. Almost there. I think this is it. VWAP's got to go away. This gap right here. Almost always when you see a gap on the ES, it gets filled pretty quickly. A gap like this, especially, that isn't a contract roll. So at 68.66, under 6,900 is going to be support. If they break down through 68.66, then I would look for the gap fill. If they hold 68.66 and take it immediately back over 6,900, then I would be looking for 7,000 and a pretty direct move. But 68.66 is going to be your main line of support on the ES today, to the downside, to kind of show if they're going to follow through or not. depending on where they close this candle, you're seeing again these long wicks telling you that the buyers are active at this level. Um, Same thing you saw up here. The buyers were active here. It took them a while to get back through that level, and then once they did, then it was game over to the downside. But this level is obviously just as active. This 687.90 to 80 level is right now major support, minor support, not major, minor support, above the pre-market low, which would also act as support. But I think that because they've been down here so many times, this number is no longer that important. If they break through, they're going to break the pre-market low. Probably go for the gap fill. When you see a number like this that's going to be your support and they come down near it so many times, that tells you that um, they're not going to have support here and then say, oh, no, here's the actual support. Very often. They can, but more often than not when they do this, this is where they're trying to hold. And if it gets through, then they're going to go ahead and let it go through. Well, go ahead and do it already. All this spike down, spike up, spike down, spike up stuff is getting old. Sure looks like they want to get through here and get down to at least the pre-market low, and we'll see there. Like I said, with so much support being in the area they're in right now, from the prior candles, seeing them with all their long wicks, getting through and breaking that level will likely take us below the pre-market low, and down toward that close from yesterday, and close the gap, and then they could start to charge from there. Um, There's the breakthrough. We got 60 out. All right, we stop out there. Got 172. All right, kind of a nothing day, which is how the Fed goes. Ryan, you wanted to see the UVIX. Give me 1 second. Let me update the group, and I'll do that. So as I mentioned, this wasn't going to be support very likely given the overall structure here. I would assume the gap closed as their next target, but they have pushed through the pre-market low. We'll see how they follow through to the downside. Now, if they get through the gap close, that does open the door to this being a little bit of a red overall day. So we'll see how they react to that. Let's go to the UVIX here. And guys, I'm not worried if they take it up and we get a buy and they ram it, all the way back to the highs and we miss a trade. That's part of trading. You should never worry about that. You should never be mad about it. It's just is what it is. You have to use some common sense and say, what does the market doing? What kind of day is today? Today is Fed day, so a lot of random stuff going on. A lot of chop, very likely. Ryan, did you have a particular scale you wanted to see this on? The VIX is in a buy off of this low. Currently, sell off the high. So it was indicator nailed this one. But currently it is on a buy off of today's low, which is pre-market low is just below it. So given this failed breakout up here, I do think they could come down and hit 907. And we'll see what they do. But this is very, very similar to what the ES chart looks like, which is that they'll come down and tag this and maybe not even hold it since they got so close to it. What was yesterday's? Okay, I see they broke out well above the pre-market high and then came back down. That's a big turn. Not for the VIX, but just in general. Yeah, I mean, right now it's looking like currently volatility is trying to rise on a buy. You want to see the 4 hour? Okay. So it's in a sell from all the way back here, on the 4 hour, and has not gotten anything that has reversed it as of yet. So this sell came in, wherever I don't know exactly where the indicator printed the sell in this bar. Somewhere in this bar it printed it. But from there it's down, 20% or so. Does that work? All right, guys. I appreciate you being with me today. Fed days suck. They're just slow and grindy, and they're over elevated options pricing. And while we haven't truly gone through a trend day or anything, we've had 3 trades, and the overall market should start to get a little um, a little more sideways as we move closer into the Fed and await the decision. I think you're going to get less and less movement. So trading doesn't seem like a great thing to do, but trade at your own risk as always. And we will see how the Fed decision plays out. We'll be back next Wednesday to do this again. Let's put this back where it goes. There you go. Again, guys, I'm not worried about this buy playing out. If it does, it does. If it doesn't, it doesn't. I think you're going to get a lot more chop today. So I think you're going to see a lot of sideways stuff. So again, trade at your own risk. I would not be jumping on any more trades. In fact, I'm not, because I'm ending the stream here in just a second. Thank you guys again. Appreciate you being here. We'll do it again next Wednesday. Have a good day.